Well, folks, we have a lot to get into in this one here today. I posted this on X about 57 minutes ago or so, down $92,000 in the public account here today. We'll speak about what's kind of going on there. We're going to go through my possible buys watch list. We're also going to talk about what's going on with big tech here today. Why are some of these stocks down so massive? So we'll get into all that in this video, kind of share if I think this is going to be a lasting move here, if this is just a little short-term in nature move. Then I have some videos I want to react to, some little clips here. First one up, Yardeni speaking about inflation, speaking about recession, those sorts of subjects. We'll react to that. Want to react to this one. The pullback in chip stocks, particularly ASML, is overdone. That stock is down about, I think it was about 10% here today. So we'll speak about what's going on there. Affirm CEO on the consumer behavior. Now I wanted to watch that because I saw this clip, and this was just a bit ago, 32 minutes ago, and this gentleman makes it sound like things are great, but I'm going to point out some very important things in regards to that video, okay, and how to look at something like that. And then the last one up here is this little clip. Global chip sell-off is a bend, not break trade. So looking forward to getting into that one. Appreciate y'all joining me as always. Thank you so much for being here, folks. It's a busy action-packed video here today. Pinned comment down there today. I'll put my private group in probably my Instagram. So if you want to follow me, no, you know what I'll put my X in my Instagram as a pinned comment. If you want to follow me on X or you want to follow me on Instagram, I'll put those as a pinned comment down there today. Okay. So obviously massive move down here today in the public count. Ugly one, certainly. And that is part of the game. When you're a stock market investor, you're going to have ugly days. You're going to have ugly weeks. You're going to have ugly months. And honestly, you will have ugly years, right? You know, if I think about a really ugly year for me, it was certainly 2022. 2022 was vicious, right? And so that's just... it's part of the process, man. You know, if you can't take the $92,000 down days, you can never have the $92,000 up days. That's just the bottom line in regards to that. You have to be able to have it on both sides, right? Now, why is this? Okay, let's be very clear. The public count is having such a bad day because of three certain stocks. The first one is Meta. Meta alone's pulling that portfolio down about $48,000 today, right? $47,787. That's a vicious move down there for Meta, and Meta's become such a big weight. Now you may say, why don't I sell some Meta? Since Meta is such a huge weighting in that portfolio, about, you know, we can call it $2.2 million portfolio, about $800,000 in Meta. Why don't I sell some Meta and go ahead and position that elsewhere so a day like today wouldn't happen, right? Well, if you go to ever sell a stock just because of any reason other than you think the company's overvalued, or you think the company's best days are behind them, or you got better places to put the money, you're probably selling for the wrong reasons. You're absolutely always selling for the wrong reasons. If you're just selling because this stock went up so much and it's a big part of my portfolio, that's what it should do. That's great. If you have a stock and you put, you know, $200K into it like I did Meta and it becomes $800,000 position, great. That's good. Doesn't mean you have to sell it. That's not the way this game works. And so you got to let these, you got to let your top tier companies really ride in regards to the situation, right? If I was to pull up, 1000X and we look at Meta's valuation at 22 forward PE, I'm going to sell, you're telling me I'm going to sell Meta at 22 forward PE? One of the greatest business models in the creation of mankind? A business model that seems like it's got almost every person on the planet using one of their products, whether it's Facebook, Instagram, or WhatsApp, right? Was Zuckerberg still in the prime of his career at a 22 forward PE? Come on, man. Like, I just can't make a move like that. Like that's crazy, right? If I was to compare Meta versus some of these other big techs, you'll see how cheap the valuation really is in regards to stock, right? We can compare them against Microsoft here. By the way, if you want access to 1000xstocks.com, you want to apply for access to that, you can go to 1000xstocks.com on your browser and apply for access there, okay? So look at this, 22 forward P for Meta, 33 for Apple, 35 for Microsoft, and guess who has the best growth of all three of those companies? Meta, right? So why? Why would I want out of Meta? Like, that just doesn't make logical sense, right? So, these are things to kind of take into account. When you compare three companies versus each other like this, you really start to realize how much of a deal one of the companies is, and that is Meta. So, as far as selling that stock just because of a big weight, come on. Now, ELF is certainly hurting the portfolio huge today, 8.6% down. ELF's had a little tough run at it. We'll probably talk about ELF a little bit more in this video, right? But yeah, that one, $16,000 down here today. And that's no bueno. And then Nvidia is certainly hurting the portfolio. This isn't a very big position for me, but it's a position nonetheless. And when you go down 6.6%, it's another $2,700 down there as well. So those three stocks are some big percentage movers down. Then you add on Tesla as well. And next thing you know, you got a $92,000 down day for the public account here today, right? Now, going ahead and looking at my possible buys watch list here, we have some interesting things going on, okay? So Shopify's having a massive move down. This is great. I love this. I mean, the bottom line is Shopify is one of those stocks you can just buy and buy and buy and buy and buy and buy for the next year or the next several years. And, it's just a very easy stock to own for the long term. It's a very, very easy stock to own for the long term. It's one of those sorts of companies that they just get more relevant year after year after year. They put up great growth rates. They're asset light in regards to that business model, right? Does it trade at more expensive valuation metrics? Absolutely. Absolutely it does, right? Forward P is 64 on this one, a 2-year out forward P of 45. It certainly does. But the growth rates, if you want to think about a company that can grow 20% plus a year for years to go in the future, that is Shopify. And how many companies can you really think of out there in the stock market that you would expect them to grow revenue 20% plus a year for, as far out as I can see? There's very few. And so when I look at Shopify at a 2-year out forward P estimate there of about 45, I say that's actually a steal deal because you're not going to find these sorts of stocks just all over the market, right? So anybody that wants to be a buyer of Shop, you should be applauding any moves down in regards to that one. Oobity booba stock, big downward move. Celsius looking like it wants to break 50. Tough, man. Tough. Looks like it wants to break 50. Did it do it? No, didn't quite do it today. Man, just brutal. Brutal move. I mean, we pull up about a 2-month on this baby. A 2-month is vicious. Look at that. 47, almost 48% down. Oh my gosh. Insane, right? The big thing I got to figure out before I buy Celsius, I've added it to my possible buys watch list, but before I actually put money in, is I'm hearing a lot of bad things about how sales are going, but we haven't seen it necessarily in the numbers yet. We're just kind of hearing about it from Nielsen data and those sorts of things. So I got to get a little more clarity in regards to that. And also how the company's going to handle a tougher sales environment because they haven't really gone through that. The brand's been so hot the last 5 years and it's gotten to become, a much more famous company than, I would say 5 years ago, like no one heard about Celsius. Now I feel like a lot of people heard about Celsius. So I got to get some more clarity there before I would actually put money in. Winstock, great buy right now. Great buy right now as long as somebody has a long-term out kind of viewpoint there. And then you got Honest making another big move up here today. Honest stock's doing this very, very well. I mean, yeah, it's getting fun in regards to Honest, right? And we'll see where that one, settles out after earnings. If they come through with another banger earnings and we see, good revenue growth out of them, we see good EPS out of them, if we hear guidance that sounds like they're going to be profitable for the following quarter, and more good rev, don't be surprised if that one breaks $5 after earnings come out. So, but we'll see. You got to wait for the numbers, and then we'll kind of see what happens there. But yeah, Honest is certainly doing us proud. It's doing us proud. So that kind of covers this list here. Okay, Starbucks actually going red here today as well. Buc-ee's is actually a pretty attractive buy. Now, if we go ahead, we look at the two stocks I'm hedged against. It's obviously a good day for my hedges, which doesn't come as a surprise with a big downward day like today, right? My Chipotle hedge is doing very, very well here today. Stock down to 55.55. That one's just been, pull up a 1 month of that one. 17% down in the past month. So Chipotle hedge is starting to go very, very well for us. I have a teeny hedge on SQQ. When I say teeny, I'm like, it's in the Patreon portfolio. I think it's like a few $100. So it honestly is completely irrelevant. Chipotle matters much more to me. That's like a multi-5-figure hedge in regards to Chipotle. So yeah, if that one, like I said in regards to CMG, if that one baby goes under 40 after earnings, or excuse me, not under 40, under 50, into the 40s after earnings, I might have to take profits on it. Even though if it goes under 50, I think it could have more downside. It's just like at some point, in regards to hedges, and especially in the way I play hedges, which is buying put options, right? You got decay there as well. And sometimes, after a huge move down like that, it's just smarter. It's a more intelligent decision just to take your profits. It's not like playing a stock from the long side. It's a completely different mentality. And that's the biggest thing I've learned kind of doing hedging and experimenting over the past few years. It's a completely different philosophy when you go to hedge. When you go to hedge and you make a big profit, take your profit. When you make a lot of money in a long position, stay long. You're a whole different ballgame between I'm hedging for the next 6 months, 12 months, whatever, and I'm buying this company for the next 6 to 12 years. It's a completely different mentality there, right? Let's go ahead and look at what's really devastating the market here today, and it's big tech. I mean, vicious. Oh my gosh. AMD's down over 9% here today. Oh man, I gotta take a screenshot of this. Oh, brutal. I might use that for the thumbnail. Oh my goodness. I mean, just vicious, right? We spoke about Shopify and Uber. You have obviously Nvidia down huge, MU down huge, Meta down huge, Tesla. I mean, just brutal. It looks like Intel's one of the few that are up. And I think there's two things. Obviously, the ASML move here today is negatively affecting a lot of these stocks. Also, T-Man's comments around Taiwan to Bloomberg, that interview finally came out late last night. That wasn't, and you can kind of look into the details in regards to that. That was a little scary. I think that freaked out the market in regards to, TSMC and everything going on there. So that's causing a little worry in regards to that. But and then the other stock I want to speak about here before we react to these videos is Elf on a Shelf. Elf on a Shelf is no bueno, right? No bueno, at least recently as far as the stock price. Whew. So if we pull up a year-to-date, it's still doing pretty dang good, 23%, right? Then we go 6 month, then we're down to 6% gain. 3 month, down to a 4% gain. And the past month, the stock's down about 10%. Past 5 trading days, very vicious, down 14.4% there, right? So the thing with ELF is it's extremely volatile, right? It's extremely volatile, and it kind of has to be. We actually don't need that anymore. And the reason being is it trades at very high multiples in regards to ELF on a Shelf. I mean, wait till you see the PEs on this one, right? It's a 60, it's a obviously 83 trailing 12 month PE, right? And the forward PE is at 60. Now, 2 year out forward PE starts to look okay, look pretty good, right? 42. But the thing with ELF is it commands these sorts of very high trailing 12 month PEs and forward PEs because the growth rates are so insane for this company, right? But it's risky in the sense of you can have big downward moves in regards to stock. Obviously, the company's so phenomenal and so well run, it's not a risky stock. But in terms of the moves down, they can be extremely violent for a stock like ELF because the growth rates are so extreme and the trades at high PE multiples. So it makes people, it freaks people out. Like, what if growth rates didn't hit? What if the current year revenue growth isn't 40%, right? What does that mean for ELF stock? Does it then command a much lower multiple than it has? Maybe it trades at a forward P of 45 or 50 at that point in time, which would be a lot of downward pressure on ELF. So ELF stock runs a little bit more on emotion than it runs on fundamentals because the growth rates have been so extraordinarily great. And so that's just a little food for thought in regards to that. Let's react to some videos.
And Ed Yardeni. Ed, great to have you back. Took note of your note last week where you went to 5,800. You used the word melt up. Has any of that changed?
Not really, no. Certainly looks as though we have not just a melt up, but a broadening melt up. That's different from what we had in the late 1990s. In the late 1990s, we had a melt up which stayed very, very concentrated in technology, particularly large cap technology. This time around, the melt up that we've seen in technology and communication services, at least in the past week, as you folks have noted, seems to be broadening out to the mid caps, the small and mid cap companies. And I think Don was very accurate in pointing out that it has been some short covering and certainly
If anybody's brave enough, let me know how much you're down today in the comments section. If you're brave enough, go ahead and leave it down there. Down 1K today, down 5K, down 50 grand, whatever you're down. If you're brave enough, let me know in the comments. It makes us all feel better. That's why I love to show big losses on a day like today, right? Because it makes everybody feel better. I actually see a lot of comments sometimes like, oh, it makes me feel good when you post, losses like this. So, other people are going through it as well, right? In regards to a downward day.
In biotech and in regional banks. So it's widened out. I think the widening out, though, is going to increasingly focus on the S&P 473. In other words, money may continue to come out of the Magnificent Seven, or money won't go into the Magnificent Seven, and will get redistributed to the rest of the S&P 500. The problem with the SMID caps is earnings. The earnings still look pretty punk. They've been kind of flat for them.
So the issue with that thought process, I've got to be honest with you guys, there is an issue with it. This thought process of like money floods out of these stocks, goes into these stocks, out of the large, into the small. There is an issue with this, okay? The issue is that only is true for really actively managed money. And keep in mind, actively managed money nowadays can be a much smaller amount. Much of the money in the market is passively invested. We could call it not the most intelligently invested, if we want to put it that way, right? Passive investing is I'm just putting in an index fund, right? And I don't know how to do anything, and so it just goes into the biggest stocks. And the biggest stocks that are the biggest get even more money, right? Sounds a little bit like Ponzi. No, just kidding, okay? But in all seriousness, it's not ideal from a lot of different reasons. It can make the top of the market much more overvalued than it should be. Companies that maybe deserve to have higher multiples maybe don't get that because they're lower down the totem pole, because so much money is just going into, I don't know what to do, so they just go to the top, right? It just funnels to the top. And it will, there will be obviously a day of reckoning when it comes to that eventually. When that day comes, it remains to be seen, but it will come crumbling down, and that's going to be an interesting moment, because I think there's going to be a lot of people that are going to be questioning passively managed money, right? I shouldn't even say managed money, just passively invested money. But until that moment, a lot of people kind of gravitate toward that thought process of like, I don't know what to do, so just put it in the biggest stocks, at the top of the market. I don't know, I don't care that they're super overvalued, like I'm just going to buy those stocks. And so that's a kind of phenomenon you have going on. Whenever the market does break, for real, and when I say break, I'm not talking about, the market went down for a week, a day, a month, something like that. I'm talking about the market's down for a couple of years and down in a substantial way. When that happens, you're going to have a lot of people questioning about, kind of passive investing at that point in time. So, yeah, I wish I could say all this money's going to rotate from these big guys to these small guys, but it's only going to happen for that actively managed money. So much of the money in the market is passively invested. So just food for thought.
2 years.
Exactly. And you did say last week that you were wary of Fed rate cuts because of the sideline cash that it would draw into equities. Explain that.
Well, I'm not in charge of the Fed, and I rarely go out of my way to tell the Fed what to do. But
look at this.
As a strategy.
Look at this. Just have a look at this, right? Look at it. Look at the stocks that are actually green today, which there's not a lot, right? You got Honest, a small cap, massive move up here today. Planet's up, micro cap. Avant's up, micro cap. Fubo's up, small cap. SoFi's up, some people might put into more mid cap. I consider anything under 10 billion nowadays in the market a small cap. SoFi would fit into the small cap category, right? Revolve, small cap. So you're really looking, and it's like the ones that are green are actually really like the small caps. And then, a lot of the bigger dogs are just absolutely red dead redemption out there here today, right? So, in terms of the actively managed money, it's certainly still flowing that way and probably will continue to, but we got to, once again, understand a lot of the money in the market is not actively managed. By the way, if you're confused at all what actively managed means, that means somebody's actually making decisions about, I'm going to sell out a Meta stock and I'm going to go buy, whatever stock, Estee Lauder, okay? Oh, I'm going to go buy McDonald's with that money. Oh, I'm going to get out of Wells Fargo. I'm going to position over to JP Morgan. That's actively managed money. They're actively making moves out there. Passive investing is just like, here, the money's just going to these certain stocks. There's 6% of their money's going to this stock, 4% is here, and kind of like this set parameters there.
I think that if the Fed moves forward here on lowering interest rates, And it looks like it's locked itself into that pattern. It looks like they're pretty much committed to cutting rates in September. I mean, the markets will be totally blown away if they don't, because now the expectation is 100% that there's going to be a 25 basis point cut in September. So that's in there. And that certainly explains this melt up and now this broad.
So honest, it had a flirt with going to the fives back in March, right? And then it kind of had a downfall, and then it's back up on an uptrend again. So this time it won't flirt. It will go over 5 once again if earnings are actually really good and the guidance is really good out of the management team, and if it especially if we get any clarity about the company being profitable and staying profitable. If the company, I'll just be honest with you guys. If Carly was to come out and basically say the company's profitable, we're going to stay profitable, we're expected to be profitable every quarter, GAAP net income for here on out, basically, or for the remainder of this year or whatever, the stock's going to 5+ just in that situation alone. So, the upward momentum is pretty fun as long as things go right? If that wasn't the situation, or they lost a bunch of money or something, that's a whole different ballgame there. But if things keep on this up and up, 5.
We're seeing in the market. I just don't want to see a melt up, because the problem is, as an investment strategist, then I got to be smart enough to tell everybody when to get out when it's about to melt down. I much prefer civilized, gradual bull markets. But hey, look, it's not what is good for me. It's what the market intends to do. And right now, it feels as though the market is pricing in at least one. Well, actually, the market's pricing in 5 Fed funds rate cuts of 25 basis points over the next 12 months. That's what it's doing.
But Ed, there's a difference between broadening and rotating. And today
Correct.
It feels like one of those sort of uncomfortable days, at least if you're in the NASDAQ or any tech stocks, which NASDAQ's down 2.4%. The Dow is higher. So how do we know which one it is and what's healthier?
I think it's broadening. I think it's healthy to see the NASDAQ have some sort of sell-off. It's just been going straight up. So seeing some profit taking in that index makes sense, especially since there is actually some mildly bearish news, such as you folks mentioned, that the Biden administration may try to make it even harder for ASML and other semiconductor equipment manufacturers to sell to China. In addition, former President Donald Trump is talking about asking the Taiwanese to foot the bill for defending them vis-a-vis mainland China. So there's bad news out there. The market's taking some profits on it, and those profits aren't totally leaving the market. They're quite the opposite. They're going right back in.
Yeah, so Ed didn't really have a lot of interesting things there, I'll be honest. It's kind of like a lot of the same talk we've kind of heard out there. Next one up here, the pullback in chip stocks, particularly ASML, is overdone, this gentleman
Price target of $1,320. And it says, despite geopolitical risks, focus on growth. All right, well, let's start off with the geopolitical risks if we can, CJ. What do you make of it? Both, the former president's comments about Taiwan and perhaps more importantly, what may be coming moves from the Biden administration to even try and tighten up these restrictions on China getting a hold of high-end chips.
Yeah, good morning. I think, the potential for more restrictions is real, but I would highlight that, we've already limited EUV, unavailable to China, and ASML, currently cannot service 5 different factories in China. And so the intent is really to limit China's ability to build leading edge semiconductors. And I think that the efforts the Department of Commerce, the BIS, have put through have done that. But clearly when you saw that 7 nanometer chip come out of Huawei in China, that led to the red flag. And so, I think there are considerations. It is bipartisan in D.C., but I would, suggest that we've already done enough on that front. So I think, the pullback in stocks, particularly ASML, is overdone.
Yeah, well, there it is, down 10%. I mean, again, in terms of the actual numbers reported by the company, generally positive, correct?
Yeah, I think that there was wide debate whether their bookings would come in at the kind of 4 billion level or upwards of 6 billion as we forecasted, and they came in, right around 5.5. So that was definitely.
Here's the deal. Okay, people make such a big deal about, oh, this person said that, T-man said this, B-man said this, blah blah blah. Here's the deal. Okay, ASML. People are looking for a reason to take some profits out of this one. This isn't the sort of stock they usually expect to go up 50%, 100% a year. And going into today, the stock was up, 40 plus percent? The stock was up 40 plus percent year to date, right, for ASML. And once again, this is not a sort of company that you really expect to be up a 50% or 100% for a year. So even after today's crash in the stock, where it's down 12.5%, it's still up 30 plus percent on the year, right? 30 plus percent gain on the year. Is it the 40, 45% it was up yesterday for the year? No, but it's still having a phenomenal year. And I think at the end of the day, for some of these, they're just looking for a reason sometimes to sell stocks. That's the other thing you got to understand about the market. When these stocks have an extreme outsized move and a lot of folks are in them, they're looking for a reason. Just give me a reason to sell the stock. Oh, this was said. Oh, somebody said blah, blah, blah. You even put the pieces together and it doesn't even make that much sense. I mean, the China restrictions, it's nothing new. But people are just looking for a reason. Give me a reason to take some profits here. In Wall Street, they love to take profits when they can finally get them because they don't get many.
Good enough. And I would definitely highlight, when TSMC reports this evening, I think it's going to be a strong report. And it's really going to highlight, that today it's led by AI. And, we are starting to see kind of a return to seasonal trends in some of the other markets like smartphones, PCs, enterprise servers. And so I don't see any real change statement, to our, the outlook for very strong growth for ASML next year, which, again, they reiterated on their call this morning.
Yeah. Well, I'm curious, though, in the difference in your perspective in terms of the effectiveness on the bans that have been in place versus what may be some frustration on the part of the administration. Where does that play in? Why are you seeing it as successful and perhaps others seeing it as not so successful?
Yeah, it's a great question. I'd say that the fact that Huawei was able to build a 7-nanometer chip, is alarming, disturbing relative to, the aims and goals of the administration. And that, I think, has led to potentially a vision of putting more restrictions on ASML and their competitor Nikon and not allow immersion tool shipments to China. But, if you recall, the Department of Commerce put regulations on 16 nanometer and below for logic, not on 28 nanometer. And if you were to put a full embargo on, select immersion tools from ASML, that would basically, prohibit China from building even 28 nanometer chips. And I don't think that's their goal. So I think, not allowing servicing tools at specific factories in China, will serve its purpose. I think not allowing EUV tools into China will serve its purpose. And so, in my view, that's enough. But, to your point, this is, one of the one areas in D.C. where both parties agree. And so, could we go overboard? For sure. I think that's what the market is reacting to today.
Always scares me when both parties agree. No, so let me make a case on why these China restrictions are actually a bad thing. Since both parties agree that this is great, we should restrict China from having access to these chips, to manufacturing equipment, etc., right? Let me make a case and play devil's advocate why that's actually not a good decision, why it's actually not an intelligent move. So, you want to put all these restrictions on China? Well, then they start focusing on, well, we can't buy from the United States all these chips or this machinery we need, blah, blah, blah. So what are they going to do? Are they just going to say, oh, well, or are they going to figure out ways around the system, right? So one way around the system is they can figure out other countries to buy this equipment from. That's potential. Or they could say, you know what? We're going to go ahead and we're going to build this technology ourselves. They can obviously get access to these chips. Like, it's not impossible, right? You can get access to anything in this world. Okay, you get access to chips, you get access to machines. Then you can start copycatting them. And we know in China, they are the best at copycatting. There's no country that's better at copycatting than China. That's just straight up facts, right? So you think they're not going to be able to copycat these chips, these machines? Of course they're going to be able to over time, right? Maybe not initially, but they're going to be able to. And then once they copycat them, they could actually start competing with a lot of our companies over time, right? On a global scale. So if you just sold to them the chips, they would never even have the incentive to, let's try to build this ourselves, right? It's like, oh, we're buying this from these United States-based companies. Okay, United States-based companies make a bunch of money off that, right? And then they don't even have to worry about these Chinese companies ever competing with them. When all of a sudden they have to worry about them competing, that's a whole different ballgame. That's a whole different market, right? And especially for the long term. Maybe it's not something you see in the next 3 to 5 years, which I understand politics is a game of, thinking about the next term, right? The next 2-year, the next 4-year term. But if you're really trying to set up the country better long term, for the next 10, 20, 30, 40 years, there's actually a strong case I could make for you should let the Chinese companies just buy from our U.S. companies or non-U.S. companies, and then they don't even worry about trying to make their own technology. They don't even worry about trying to make their own companies and those sorts of things. So I don't know. That's just a little food for thought in regards to that. Affirm CEO on consumer behavior. This is a tricky interview. Let me explain it.
We never revealed the story until it's over. So I hate to disappoint without precise numbers, but things are looking pretty good. I think the stories of American consumers hiding their wallets and staying away from shopping are greatly exaggerated. Folks are buying. You can see the numbers speak for themselves. The demand is well spread. We're still seeing excellent strength in every category from apparel to electronics. At this point, the sort of story of post-pandemic travel needs to be retired. It's just shopping is back on and people are buying. And that's not to incidentally reduce the real load people are feeling from the pinch of high prices. I think the story of American consumers still being pretty resilient is not the same thing as them not caring about the prices being high and inflation still remaining relatively hot.
I agree, and I actually wonder, so what you're saying actually jives with what we learned in retail sales data for last month as well, but also the disinflation that we've been seeing in e-commerce specifically. I wonder how much of that disinflation has been a headwind to the prints we're getting in terms of spending. In other words, could volumes be healthier than nominal numbers would tell us, right? If I buy a sweater or a piece of furniture that's 15% cheaper than it was a year ago, I'm still buying it. And so I wonder again if that's kind of causing some confusion about how the consumer is doing.
Yeah, and doing this in constant dollar math is probably beyond my ability. Affirm, to be precise, is doing really well. Our last quarter, we grew 4 times the rate of e-commerce, about 36%. Regular e-commerce grew something like 8.7%. And so I think from where we sit, our growth has been extraordinary, and we continue to deliver value to our merchant partners and consumers. I think the trends are definitely hard to read. I always look at sort of things that are fairly constant, most importantly, employment or unemployment numbers and just the internal growth. And we're still in almost a fully employed economy, although it is ticking up, unemployment is, so it's a little bit concerning there. But demand is really strong.
Yeah, it's reassuring.
So a couple problems here, right? He makes it sound like everything is really rosy, demand's really strong. I would say there's 2 core problems here, right? One is a company like Affirm, obviously buy now, pay later, relatively new segment, right? Like I would say if we even went back 5 years ago, most people had never really heard of buy now, pay later. Like there was like what? Buy now, pay later, what is that all about, right? And now, obviously, it's a much more known concept, so they're kind of in more of a growth space in general, right? So that's one thing I'd factor in. And so if you're thinking like, oh, things are rosy, things are positive, that's something to factor in. The second thing I think is much scarier and much darker, right? And that is, okay, a company like Affirm thinks they're doing well, but maybe that's because people are going to, if people have a way to buy stuff, they're going to buy stuff, right? Maybe people don't actually have the money to buy these things, and so they're putting it on Affirm, right? Buy now, pay later. That's a little food for thought in regards to that, right? So I don't know. These are just things to consider. I think those are 2 really big factors to consider. So if you hear an interview like this, you're like, oh man, the consumer's doing great. Everything's awesome. Take those two things I just gave you and factor those in. We
would expect buy now, pay later. I would. I mean, I'm very curious to see what happens throughout this cycle if it eventually turns. When do you guys start experiencing, I don't know what we're traditionally called default rates, right? Or when a consumer, if they're not making payments, they get pushed off of the service and so forth. Would you see any sign of that yet? Can you break down any composition of the consumer to suggest if there are any segments that are under pressure?
Almost 2 years ago, we talked about seeing some degree of softness in the folks in the lower credit tranches. But since then, we've really not seen a tremendous amount of change. And so, again, I think U.S. consumer is fairly strong. Incidentally, I take issue with the term buy now, pay later, but I'm willing to go along with it if you call credit cards buy now and pay forever.
Okay, wait. What would you call yourself then? If we, what do you? What's the term?
I think we consider ourselves a great alternative to credit cards. We talk of ourselves as a better way to pay. The most important thing that we deliver to our buyers, to the consumer, is a sense of certainty and ability to control their finances and have a really clear picture of how long it takes to go from starting to pay for something to wrapping it up. That my joke about credit cards being buy now, pay forever is all about this notion of revolving. It's just that,
and that's what they want. That's how they make money. Yeah, absolutely.
That's how they make money. Exactly. We don't revolve. We don't allow revolving. We don't charge compound interest. We don't charge late fees. Even so, we think of ourselves as a much healthier product. The thing that's really apparent, and we run tons of surveys, and we've just surveyed thousands of Americans. 90% say that having a predictable monthly budget is what they see as a top priority as they manage through inflation. This notion of consumer weakness, it's the other side of the inflation coin. They feel like their money is leaking out and they can't tell where. The reason buy now, pay later, as much as I dislike the term, is growing as well as it does is because there's no unpredictability. There's no revolving. There's no figuring out what's the minimum payment. The payments are precise. And so in that is the value that we provide. That's why consumers are turning to us during these sales like the Prime Day events.
Buy now, pay less. Buy now, pay a little. Buy now, pay on a predictable basis. We will come up with something, I think.
She came up with a genius slogan right there. That man should take that and run with that. Buy now, pay less. Ooh, that's a genius one. Hire her head of marketing, man. Hire her away from CNBC. Alrighty, next one up here. Global chip sell-off is a bend not break trade.
Now we're going through a huge rotation, right? Smalls are running fast, value's running, and you're seeing a little bit of waver in the growth. For me, it's a bend, not break trade. I see this as a breather after a massive run up. Plus, you had Trump's comments on Taiwan that kind of spooked the markets. Could there be more tariffs coming? So for me, I see this as a breather. You could face some near-term tactical headwinds in chip stocks, absolutely. But again, I don't think the trend is broken. So if you have large gains and you're in a taxable account, you need to be thinking, do I really want to dump my NVIDIA? Do I really think NVIDIA is dead? For me, no. Pull back, consolidation. Under pressure, looking near term, small in value, running, chip stock kind of lagging behind, but I don't want to sell them.
This lady's always awesome. She's like type you go get a pizza and beer with, man. Cool lady.
Early, because I still think we're in middle innings of the AI play.
All right, so we've also been talking about some of these other parts of the market, those quote-unquote unloved names, getting a boost recently, small caps, also transports. I'm leading you into your Wex word of the day. What is it?
It's pivot. You got to think of it from the Friends scene, right? Ross on the couch just screaming, pivot, pivot, because that's where we are right now. We're seeing the smalls lead, the values lead. This is fantastic for the market, right? This increases our breadth. It's just more and more behind the bull market theory because now you have participation from more sectors of the market. Yes, you maybe need to own more than 7 stocks at this point in the market. But then again, you've had Teflon names like Tesla that are coming through, will hit earnings season. Earnings growth expectation is still high. But
so for the bears, this is a really tough moment for the bears out there. I got to be honest with you guys. And the reason being is the one thing they've really had to go off of is, only the top of the market's doing well. The breadth is horrible. All those other stocks are doing bad. Well, if all these other stocks start to pick up and start to do very well, what do you have to go off of at that point in time? And then we see some rotation out of some of the big techs, and so valuations look more cheap or more fairly valued for those the top of the market. What do you have to go off of then? Then you're still waiting for kind of a real, true, like big break in the economy, right? Where unemployment goes to 5% plus. So until you get that moment, you don't really have much to run off of if you're really super bearish on the market, right? Because the Fed's not going up anymore. They're going to likely start cutting. So, that's tough.
Term, yes, absolutely. Pivot, be looking at other things than just those Mag 7.
We're also going into day.
You know what I want to do? Something important here. I want to see how commodities, I want to see how they've been doing here recently with obviously the market feeling like it knows the Fed's going to be cutting. Where's GSG at now year to date? I love it, man. I love it. I love it. I love it. I swear that I love it. Oh, yeah. Okay. WTI. I mean, we're in the middle of summer right now. WTI up only 14% for the year? 82 in the middle of summer? We'll take that every day of the week. We'll take oil, $82 in the middle of summer. We will always take that. So that's another thing. If you were a bear and you're like, okay, commodities are running huge, we're going to have another massive spike in inflation. We don't have that.
RNC. A lot of people are talking about the quote-unquote Trump trade. How much of this rotation into other names do you think is part of that Trump trade? How much of it is just many portfolio managers are over-positioned when it comes to tech?
Well, it's hard because you were left behind. If you didn't own Index Weight Plus, it was very hard to beat the S&P 500, which is the main benchmark. So I think you're overweight. I think you could see some profit taking, but I think a lot of investors and a lot of portfolio managers are going to look at the tech trade and say, look, this is where we see growth coming from, and we still think it's above market growth, and we want to hold these names. As for the Trump trade, I mean, you've seen a lot of that get priced in the last week. I think the big one's going to be tariffs in China. Obviously, JD Vance has some pretty strong opinions on China. And so for us, that's what we're looking at, who's exposed to Chinese revenue. I think we still would support Taiwan. Some of this stuff, you got to realize it's an election year, and you're going to hear a lot of crazy things between now and November. And I strongly do not think you should position
Genius.
Portfolio at things you hear during campaigning, because that's often not what turns out to be what happens after November.
100% accurate. Thank you, ma'am. Thank you.
Out of time, but you're also bullish on financials right now, and also an alternative asset manager.
They all do it. I've never seen a politician in my life, not one, say we're going to do this, and actually do it all, or even close to it all. They always say, oh, I'm going to do this, I'm going to do this, I'm going to do this, I'm going to do this. All these things in a campaign, and then you look at what they actually end up doing. It's a very small amount of what they said they were going to do. So she's 100% right. When these guys are campaigning, don't believe everything they say. Actually, don't believe most of it.
So, and I'm looking at the chart. Blackstone only up about 4.5%. Why buy it today?
I think they're going to kill it on earnings. They have $1 trillion. They're still bringing in money. The BREIT, the real estate has been a drag on them with the Starwood. But look, BREIT redemptions are slowing. They're still growing. Private credit's growing. As interest rates come down, investors are going to be looking for areas. How do I get more income? I see alternatives as a natural fit. You're also going through this democratization of alternatives where they have interval funds and ways to sell to more retail clients that haven't had exposure. I see BlackRock well-positioned to pick up assets and well-positioned to grow their
BlackRock or Blackstone? I don't know. Were they talking about BlackRock there at the end or Blackstone? Because they had one graphic and then they're talking about another, okay? All right, guys, appreciate you joining me as always. If you're looking to apply for access to 1000xstocks.com, you can do so by going to 1000xstocks.com. If you're looking to follow me on Instagram or X, you can do that with the pinned comment down there. I'll put both of those. Much love and have a great day.